What's it going to cost me? Okay, crucial. Everybody wants a piece of you, but the state gets, the taxes get the most, okay? Depending on how complicated the deal, if you have real estate, some of you have bought your buildings, okay, that you're in. It might be under a different LLC, but maybe there's some, maybe the buyer, so one of my business I'm selling the building with the business. So I have a real estate broker's license, so I sell the building under one contract and I sell the business under another contract. Okay, so sometimes you have to do that. So depending on what your transactions are, whether or not you want to do it yourself, or you want to hire someone as an intermediary like myself. CPA, valuation expert, financial planners. Okay, I told you I'm a nerd. This is it. This is the holy grail. This is how the numbers work. Okay. Starting up at the top, $5 million. I just picked a value, okay? Most transaction value as a broker, if you're under $1 million, is going to charge you 10%, okay? Once you get over $1 million, it slowly goes down to 2 to 3%. If you're selling a $100 million company, they might get a point or half a point, depending on the value, right? It's typical. I put in here a $5 million value, so I put in about 5% for the broker, and then I put another couple points in for an attorney. Most attorneys on transactions of this size are going to charge you 50 grand. Depending on if you got a good one, they can screw you for 100. I've seen it, okay? So I basically put in 7.5%. I just had to kind of even know, but it's around 5 to 10 if you guys wanted to know that. That's a special deduction for you for tax purposes, okay? There's this thing called personal tax basis that you need to be aware of. Now, tax basis is not the same thing as equity in your company. Okay, some people are looking at their balance sheet and see this thing called net equity. And equity in your company is the amount of money you've left in, right, to grow the company. It's generally for working capital, right? I made $1 million, I paid $500,000 in taxes, I left the other $500,000 in the company, and I'm letting it ride, okay? So there's a basis in your company, okay? And if you only have one business, then that basis is your personal basis. But some people have real estate or have other things. So what happens is your business made $1 million, so you got a K1 for $1 million. But then you have this other LLC over here that lost money. So let's say they lost 25 grand, and then you had a gambling debt because you lost another 50 grand, okay? And you have some other things, or you have a big win, you sold a property. All of those get netted together to come up with what you owe in taxes, okay? So your personal basis is going to be different for you than your partner. Okay? Your partners might have different bases depending on how complicated their own personal returns are and what runs through their K1s and what their taxes. But there is a value, if you have left money in your company, there is a value that you get out free of tax because you've already paid tax on it. You've left it in. It's called working capital. Okay? Excluding a few other things. So I don't want to get complicated, but it is important that you know some people look at their equity and go, oh, I got $1 million. That means I get the first $1 million free. Yes or no? Close, but you can see that, okay? I put in $500,000 because I did, okay? How it works, state of California, welcome to California, they get their first 13 1/3. Fortunately, the feds say, well, because not every state has a tax basis, you can deduct that from your federal. Okay, so then the federal is 20, right, for long-term capital gains. Once again, I'm trying to keep this simple. There are other processes in here. But basically, your after-tax right now is sitting around 67%. Okay, so you've lost 1/3 of your sale price, and we're not done, okay? So I'm not trying to depress you. I'm just giving you the fact. You guys can argue. You can play any number you want, but I'm just giving you this how it. There is this thing called debt. If you guys have machines and you have debt, when you sell a business, you have to pay that off. That stays with you. Buyer doesn't buy debt. Okay? It can, but typically it does not. Okay? And if it did buy debt, the IRS considers that income to you because you just got relieved of debt. Okay? So, either way, you're hosed. Okay? So, I'm a tax, I want cash, right? So I didn't know this. That's why I'm telling you guys, I didn't know this stuff. No one told me. They said, oh, you're going to sell this. That means I get all this money. No, Frey, I got walloped, right? So now you're sitting around here going, okay, I just picked a random $500,000. Okay, now you're at 57%. So what I summarized here is down low, and I'm sorry for the podium for you guys, but basically you can see that you're sitting around, I would tell you 60% of your sales price. You're never going to get to 70%. It's not. I've seen it down to 50. So if you figure in 50 to 60% of what you sell it for in your pocket, in cash, Whenever you get it, you're a freaking rock star. So, I just made y'all depressed, huh? I don't make that. I'm just saying, welcome to California, right? There's another 3%. There's ways we can do this, okay? There are strategies around it. This is a very simplistic form. If you have skilled people, the whole value of what myself or anybody that is in the industry does is to provide you that you don't have to do this. But this is kind of basic 101. This is kind of my first rundown. There's only so much. There is tax avoidance and there's tax deferral, right? So we can defer your tax over a period of time with installment. We can do that, right? Tax avoidance. The only way you can do tax avoidance. Well, someone I was last night said, I want to sell my business and I don't want to pay any taxes. You can figure out that, you tell me how. I go, I can tell you how. Said, here's what you do. You sell your business and you put all your proceeds into a charitable trust. Okay? If you put it into a charitable trust, then the government says we're not going to tax it because it's in a trust. And then you can be the trustee of that and you can get paid something out of that trust. But upon your passing, all that money has to be distributed out to charity. You, your kids, your estate, nothing. Get donut, nada. Okay? So he's like, well, I didn't tell you it was a good plan. I just said it's a plan, okay? So the logic to that would be, let's say you have a whole bunch of money and you're Bill Gates, and you're like, I got more freaking money. I'm going to set up a charitable trust, and then all that money gets donated out because I have enough of all my other money over here. So there are numerous ways, and I don't want to, I'm going quickly, but it's pain. It's true pain. Yeah?
Does unfunded liability come into play in any of this?
So the unfunded liability comes into the sales price. It's risk. So if I'm another union company, the risk isn't as big to me, right? If I'm your son, and you're going to sell it to me, and you're going to finance it with all the profits of the company, doesn't matter to me because just gave me a great deal. So yes, if it's an outside third party, it does become a challenge. But it's just one of many hiccups that we have to work through. We did do an ESOP, and when we did an ESOP, we dealt with these, and the ESOP, when we got all the legal advice associated with it, with sheet metal, the attorneys basically said, as long as this is going to stay a union, it's going to be a union, it doesn't affect the value of our business. Because the unfunded liability was more than the business was worth. So it was like, oh, that's a problem. Their answer is, it's going to stay a union. So yeah.
You mentioned ESOP, just a question. So if I'm an employee and my owner of the company, is there any motive for him to create an ESOP to make his company more attractive to either the employees buying it or to a third party?
So the value of an ESOP is generally around the tax benefit of the payout. In other words, the benefit of an ESOP is if you're making $1 million and you're getting a K1 and you're paying $500,000 in taxes. An ESOP says you're a 501c, you're a not-for-profit, you don't have to pay any income tax. So instead of paying $500,000 to the government, you can now fund buying an owner out with that money, which then passes the money to its shareholders, and they get it, which is what the government wants, right? They want to diversify and diversify the wealth. They don't owe any income tax on it until they sell their shares within the ESOP. So it's a tax transfer, and it allows the buyers to have a liquidity event because of really the tax savings that the company's making. So the full $1 million can then be spent on buying out them. When it comes to selling an ESOP, okay, so let's assume everything's transferred out and 10 years later, and then the group decides they are like any other shareholder, they can sell it. They can sell their ESOP as a group or as an individual. They can sell it to some, or they can go out and sell it out to a third party. There's going to be some valuation issues depending if it's another union or anything else, but it's just like another shareholder. It's really about the tax strategy and the transference. It's not really about the ownership. If I can answer that, yes.
Can you create an ESOP using existing profit sharing money?
Okay.
You have a profit sharing plan with the company.
Yeah.
And you want to use part of that
Yes.
to fund a partial ESOP purchase of an S corporation because they can't buy it all at one time.
So the ESOP option, let me get through these. The ESOP is a phenomenal avenue and a great opportunity. San Diego has a great connection here that I can connect you guys up. But let me go through this and then I'll go through on the ESOP. There's some really great values to it. Okay, so in summary, all right, can I sell your business? Once again, it's going to depend. What do I get for it? Do you understand the sales price and do you understand the cost? I think for me, the biggest piece for you guys to understand is that don't get caught up in value, okay? Get caught up in how much cash you get at the end. And then understand that if you ever really want to sell your business, you're going to have to work at it. Your business is not an easy business to sell. You have a lot of risk. You're in an industry that the kids are not coming up through and going, this is what I always want to be, okay? The tradesmen are not good business owners. It's becoming more and more complex to be a business owner. So for many of you that have come through the trades and have learned how to be a business owner through the trades, your business is way beyond their abilities right now. You guys brought it in. It's like, I was telling somebody, I said, you're trying to sell this to your key employee who's never married, never had a kid, and you're going to give him like 4 teenage girls and go, here, raise them. You know, the kid's like, what are you kidding me? I have no friggin' idea how to raise a child. There's like much less a bunch of teenage girls. I mean, this is not an easy business that you guys are doing, and you've learned along the way. And so you have to acknowledge that although you did it, the business environment has changed, technology has changed, the kids' work ethics have changed. Okay, their communication skills suck. I mean, they just flat out suck. They would rather send you an email than call you. And we're like burning up 2,000 minutes a day and they're now 200,000 sentences or words or whatever. Like, really? You're just in the office next door. Can you go talk to them? I don't understand. Okay, and these are the people you're going, I want to sell my business to. They have no freaking grasp. Okay? So it's crucial that you guys understand from a buyer's perspective, who's going to buy your business? And that how are you going to set them up to win? How are they going to survive and be successful? Because if you don't have a plan, you're the smartest one in the room. They don't have a plan. And then you guys have to understand that you are terrible at being coaches. You are great players. Okay? Michael Jordan, phenomenal athlete, doesn't make him a great coach, okay? Some of the best coaches were not great athletes, okay? And also, Michael Jordan's kid is not going to be a Michael Jordan, so stop thinking your kids are going to be you, okay? They're not. It's just your name's on the building, their name is your name, it doesn't mean they're going to be successful, okay? Please think about this process. It's about how much cash you're going to get in your hands. You're going to have to carry some kind of paper. How are you going to mitigate that risk? How are you going to help them become successful? Learn about it. If you don't want to learn, hire someone who can help you through the process. But just be aware that although you are street fighting, successful, hard working, get her done, don't get in my way, I'm not worried about process guys, I just always win, doesn't work as a transition, okay? You have to spend the time teaching your kids, your athletes. You got to move up to the owner's box and let the players play, let the coaches coach. You got to give it to them. You will not be successful. ESOP, internal transfer, key employee, third party, fine. You want to sell it to one of the other guys, and if any of you want to buy somebody else's business, I'm sure there's a lot of buyers, there's a lot of people who will sell it to you today, So there's a lot of opportunity if you want to go buy each other out, because there's a lot of you that want to get out of the industry. I was telling you, there's 10,000 people turning 60 every day, and there's only more. So the key is going to be aware of this process. I hope that I can teach you that it's not as easy as I've identified somebody. 50% of the people said, I've identified somebody. You know the 50% that replied? I'll get you, it's a family member or key employee. You know how many of those actually work? Maybe one. They just don't, it doesn't work, you guys. I know you think it's gonna work. It does, you have to plan it. You have to work with them. They have to take the loans. They have to secure against their house. They don't have any money. They don't have the bonding abilities. They don't have it. And so you have to carry them, okay? Never too early to plan. I'm going to jump up and down and tell you this. I didn't. I'm not preaching to you because I'm some poster child. Okay, I had my head down, I worked every day, I had 3 different companies, I was running my chicken all over the place, and I'd said, okay, I'm out, okay? I think that the other key piece that I want you to understand is sell the business when the business is ready, not when you're ready, okay? Which I'm doing, okay. So many people say, I'm gonna sell my business in 5 years. Well, you know what? If you said that for the people that I talked to in 2006, when it came to 2011, they were like, holy crap, I gotta work another 10 more years, right? Sell it when the market is right. Sell it when the business is ready. Don't sell it when you are ready. It's not about you, it's about your business. If you want to get out, the business is a child, okay? It's not you. Your name's on the building, I got it, but it's not about you. You have a child who's gonna go to college. Help them go to college, help them grow up, help them leave the house. It doesn't mean you have to leave and sell the business. Just get out of the way. Let the company grow on its own. An exit strategy isn't necessarily selling. You can get a recurring revenue stream out of it. If you can build a management team in place, and then you just keep pulling in 100, 200 grand, and you can run through some personal expenses and get to that, that's okay. That is a great exit, okay? That's a reasonable strategy than saying, I'm just gonna get up and quit. Because for the most part, you guys as G1 business owners, generation 1, is you pretty much go, here you go. You've hired a new person, you're like, okay, here you go, baptism of the fire, see ya, I gotta go fight over here. And God's like, really? You're not gonna help mentor them? And you say, well then fine, I'm just gonna do it. If you can't do it, I'm just gonna do it then. And that's how you're gonna treat a buyer. And you've gotta understand that is not the industry you guys are in. So that's my key piece for you. The other piece is the 7 deadly sins. Failure is an option. And I'm telling you failure is an option because people say they want to sell, people go through the process, and then the transaction implodes. And it implodes for a lot of reasons. It implodes because the owners get cold feet. They start wondering what they're going to do with their lives. What's the value? What am I supposed to be? This is, who am I? Sometimes there are siblings. I'm going to sell it to one of my children, and my other 2 my brothers are busting dad's chops because what am I getting? Because you're giving this business to him, right? And then there becomes this implode, and the dad's like, well, and then the mom's chirping at it, and next thing you know, it's freaking chaos, right? So things haven't been thought through. The buyers are oftentimes cash poor, particularly if you guys are doing transaction work with family members or inside buyers. If they had the money, they wouldn't need to be working for you. You're not paying them that much money. You're only putting in a retirement plan so you can put more in because you guys are overcompensated. I got it, okay? And then also it is a very emotional process. It is hard to leave. You see Brett Favre struggle. You saw Peyton Manning, thank you. These are good. This is what you guys are. You are the elite athletes. You are that. And he acknowledges it, but he doesn't want to. And it's hard. I promise you it's hard. No matter how easy you think, I'm just going to walk out, I'm done. Screw this. How many times have you said you were done in the last 10 years? Well, at least every other month you've come in and said, fuck it, I'm out, right? I mean, it's just like, fuck, I didn't pay him, God damn it, I'm out of here, It's like, really? Yeah. Exactly, I got it every freaking time. So acknowledge, so just be aware that it is an emotional process. So that's pretty sad. Understand taxes. Understand that there are is one of your largest assets in your portfolio. When you look at your total family portfolio, your primary residence, your business, some of your other secondary investments, a business has value. And all I'm asking you guys to do is look at that like you would look at your house or as you would look at your mutual funds. Look at it for the sake of your kids and for people that ultimately there is a value. How do you get your money out of it? Plan for it like you would plan any of your other pieces within your asset base of your portfolio, of your personal portfolio. This is, I understand it is who you are. I got it. It is. That's who I am. I got it. I'm just begging you to, for the sake of your family, for the sake of your own health, you will leave this business. It might be involuntarily, and you might be on a stretcher. Okay? The bank might come in and take, but you are going to leave. There is no question. The ultimate answer is going to be is how do I get the value out of my business, transfer it into my estate so I can do what I want to do with it. I don't care if you give it to Save the Whales or Planned Parenthood or to your children or to anybody, but get it into yours because there's nothing worse than imploding it and then losing what you have. And my final piece that I have, and then I will try to answer a couple questions because we have, is identify your win, figure out your timeline and plan for it, and understand that an exit is not that you have to sell. An exit is that you are not valuable in the business, okay? Because the less value you are, the business can keep going. It's just an investment. You're gonna work on your house and kind of clean up. You're gonna work on your mutual fund. You make that business an investment. That is an exit, okay? That's the piece I want you guys to focus on.